Hi there and welcome to the first Abu Dhabi Bank Global Investment Outlook for Q1. I'm thrilled to be joined by Glenn Wepener, who's the Chief Strategist at First Abu Dhabi Bank. Glenn, thanks for joining.
Hey James, good to see you again.
Let's get stuck in, Glenn. So are we really going to be seeing Brent crude prices hitting $100 a barrel just like some of the Wall Street banks are predicting? What's your thoughts?
Well, obviously oil prices have had a really bullish start since the beginning of this year, driven by the continuing rebound in natural demand for crude oil, the fading fears over Omicron variant for COVID-19. But I think much more importantly has been the impact that the rise in geopolitical risk is having. So whether you're talking about the Russia-Ukraine situation, whether we're talking about more recently, of course, the missile and drone attack on Abu Dhabi coming out of Yemen. We could also mention, the ongoing talks with regards to Iran over reviving the JCPOA agreement, which so far still hasn't reached any sort of breakthrough. And then, earlier this month we had a big disruption of Libyan oil supplies due to militant activity there and some protests. So definitely, I think the geopolitical risks have been one of the key drivers for the sharp rise this year. I think that if any of these, or more than one of these, should worsen over the next few weeks or months or so, then definitely, yes, we could see a test of that $100 a barrel level and maybe a little higher. But I think it will be temporary. I don't think fundamentally it's justified right now above that level or around that level for this year anyway. And at the same time, I think we need to keep in mind that there are some downside risks as well. We have a slowing Chinese economy, for example. We have the risk that we get a new COVID-19 variant. And this is still a possibility because we do have large sections of the world that are still unvaccinated. If you look at Africa, for example, just over 10% of the population have received 2 doses of the vaccine since, I think, up to the beginning of this year. So I really think the rich world needs to do a lot more in trying to help them resolve that problem. And then finally, we're starting to see finally a rebound in US oil production. This month, I think it's around 11.7 million barrels per day on average. That's up from 11.1 million barrels per day this time last year. And it could, increase towards 12 million barrels per day for this year. So, yeah. Okay. But I think in general, at least for the short term, the market's focus is going to remain heavily on geopolitics.
You mentioned slowdown in the Chinese economy. How would a potential slowdown in that economy affect the crude oil market? Could you dig a little bit deeper?
Yeah, look, we know that China is the second largest consumer of crude oil after the US. And yes, admittedly last year they did record 8% economic growth. But if you look a little bit closer into the data, in Q4 last year, Chinese growth was around 4%. And the reason for that drop, there's varied reasons for that drop. One, of course, we had the real estate shock, where they have ongoing power problems. But I think the other key thing has been the zero COVID policy. So, we've seen these sporadic lockdowns of major cities, 10 to 15 million people at a time, sometimes locked down. This affects port activities, this affects logistics. In fact, it affects all sectors of the economy, especially the small businesses, right, who are heavily impacted. The IMF itself is actually saying that China is probably only going to grow by 5.6% this year, which is obviously a fair growth rate, but when you're looking at China over the last 10 years or so, it's quite a bit lower. And the twofold impact of this is potentially slower global economic growth, but also the potential for China to be purchasing less crude oil this year than we've been used to in the past.
Interesting. So what are the key risks that one should keep an eye on when it comes to anything that could be affecting the direction of oil prices in the near to midterm future?
If you ask me what's keeping me awake at night in terms of that question,
yes.
Indirectly, yeah, I think for me the fundamental key risk is this ongoing decline in capital expenditure going into finding and extracting conventional sources of crude oil. Now, I've talked about this many times before. I've written about it in last year's GIO. I've written it in various publications probably for about 6 or 7 years now. And this problem started in 2014, or these declines started in 2014. They were speeded up by the renewable energy transition and also somewhat by COVID-19. And the problem is that I'm concerned that this transition towards greener energy is going to be unstable because you need fossil fuels in order to make this a balanced transition. And I don't think that's happening at the moment. We can see the good example of what happened in Europe over this winter with gas prices. Now, yes, it's true to say there was a geopolitical aspect to that, but primarily it was due to the fact that they had limited spare capacity. A lot of countries, as you know, in Europe have moved quite quickly towards renewable energy, wind energy, for example. In Germany, they've shut down most of their nuclear power plants, which was clean energy, but they've moved away from there. So they had nothing to go to try and make up the difference in a short period of time. And this is what worries me. Look, renewable energy is the future, there's no question. There's a multitude of reasons why we need to go that way, including climate change. But as I say, I think it needs to be a much more balanced approach, and like it or not, we're going to need fossil fuels to help us on that way. Now, in terms of the oil market impact, this rapid decline that we've seen in capital expenditure could mean, and I think it's a fairly high risk now if we continue in this path, that in the next three or 4 years even, we could see a sudden big gap between supply and demand, and therefore a big spike in prices above $100 a barrel for a sustained period of time, because we won't be able to resolve it quickly. So I do think that governments need to look at that more closely.
Okay, let's focus a bit more on Egypt. There's a huge expansionary phase going on. It's the Arab world's most populous nation. What are the key themes that could be driving growth within Egypt?
Yeah, well, as you know, we've been positive on Egypt for a number of years now, for various reasons. I mean, you know, the government has stuck closely to its economic reform plan. We've seen a lot of investment going into new infrastructure. There's a lot of new sectors that have appeared. For example, the chemical and fertilizer industry has grown quite fast over the last couple of years. But very importantly was the gas sector. I mean, that really only started probably 5 or 7 years ago. But it's grown to the point where Egypt is now able to export some of this gas, so that's a huge benefit. More recently, starting to see a recovery in the tourism sector, which is important as well because it's a key employer in Egypt. We're also seeing a rise in the Suez Canal receipts. Central bank reserves still remain relatively high, at $40 odd billion at last count, which is roughly, I think, about 8 months worth of import cover. The currency itself has remained pretty stable, remarkably stable actually last year. That may change a little bit this year because obviously we have a changing global interest rate environment. But overall, yeah, I mean, you know, I think Egypt continues to be a good story. In terms of economic growth, we're looking for Egypt to expand by 5% this year, and probably up to 5 3/4, perhaps even 6% next year. So yeah, as I say, we remain positive. Obviously, there are risks to bear in mind, of course. Egypt's debt level is high, and that needs to be tackled. But at the same time, I think we need to recognize that a chunk of Egypt's external debt is owed to multilateral lenders, such as the IMF, the World Bank, and so on, which they have good relations with. They also have good relations with the GCC countries, who've helped them in the past, and I think if they needed the help again, it would be forthcoming. More recently, there's been a deterioration in the level of foreign assets held at the local banks. That's something to keep an eye on. But I think that might improve somewhat in Q1 of this year when we see a little bit more of that foreign portfolio inflows come back into the market that went out towards the end of last year. But overall, like I say, we remain optimistic on Egypt.
Taking attention away from Egypt, let's look at Africa in terms of the continent and maybe countries. What country should investors be keeping a sharp eye out this year?
Yeah, so in this year's GIO, I actually focused on 3 countries. I think the reason being that I think these are countries that don't often get much attention in the mainstream financial media. Admittedly, yes, they are smaller economies. They're pretty much frontier markets, if you like. But they've made some remarkable progress over the last 10 to 15 years. So the 3 I'm talking about is Ivory Coast, Rwanda, and Ghana. All of them have implemented quite broad-ranged economic reforms, cutting red tape and so on, making it easier for people to invest, making it easier for small businesses. They've also tried to diversify into other sectors. Because traditionally these countries relied heavily on the agricultural commodity export, like cocoa, for example, which is very big for Ivory Coast and Ghana, and it remains so. But there's been a move toward expanding energy sector, the manufacturing services, telecommunication, tourism, which obviously all helps. In general, as I say, I think these are countries to watch. They've had very high growth rates over the last few years, up until, of course, COVID-19. But even in 2020, both the Ivory Coast and Ghana recorded positive growth, which is one of the few countries, including Egypt, by the way, that actually managed to record that. For this year, we're looking for all three of those countries to probably record around 6% economic growth and maybe 6.5% to 7% next year. So it's something to watch, I think.
Very interesting. And very lastly, being a bit cheeky, let's talk Iran. So do you think a new deal will be signed? Can you shed a bit of light in terms of that topic?
Yeah, it's a good question. I mean, everyone's wondering about that one. I think the mood at the moment is seemingly, especially in the oil market, that a deal may not be reached. And granted, I think we're in the 8th round now or so on, and there hasn't been any clear progress. Although there are some comments coming out recently that there could be. I think it's a 50-50. I don't think a deal is priced much at all in the market at this point, and I think that people need to be aware of something, that if a deal is signed, some people also think, well, it's going to take Iran some time to get its infrastructure, rebuilt up again so that it can start exporting a large amount of crude oil. But, over the years of the sanctions, Iran's been storing away barrels of crude. In fact, I think it was the Refinitiv data that I got this information from.
Thank you for the plug.
They basically, I think it's around 200 million barrels that they have stored onshore and offshore, and these can be released pretty quickly, right? So you could be looking at an additional 1 million barrels per day coming into the market over a 6-month period. Okay, fine, it's a temporary period, but I think obviously it would have a definite impact on the market. But in terms of them reaching a deal, I think they need to reach a deal within Q1. If it doesn't happen in Q1, then I think it becomes much less likely.
Always very insightful. Thank you so much, Glenn. Always a pleasure. Take care.
Thank you, mate.
Thank you. Bye-bye.